Great. Hello, everyone. This is Janice. I'm the managing attorney from the Low Income Taxpayer Clinic at Maryland Volunteer Lawyer Service. I want to thank everyone for joining us and to please remind everyone that we do encourage you to become a volunteer, and if you are not already, and I do see several people online who are volunteers, so thank you very much. I just want to go over a couple things here. These are some resources for MBLS volunteers. We do encourage you to take this information that you're learning and apply it in working with some of our clients. So to find that information, you can go to our pro bono portal. And so if you'll move to the next slide, please. This is our pro bono portal. It's available online 24 hours a day. Our clients are categorized according to topic type, and if you'll see on the top line there, there's a blue tab that says tax, and that will take you to all of our tax clients that are available and in need of assistance. So again, please, I encourage everyone to use this great information that you're going to learn and apply it to assisting some clients. It's a great way to get some practice and to learn how to work with these particular topics. Next slide, please. There we go. And finally, I do want to encourage everyone to follow us on social media. We do have some great trainings and events coming up, as well as our Celebrate Pro Bono event in October, which is a celebration and a thank you to all of you who are our volunteers. So, a couple of logistics about our talk today. I'm going to let our speaker introduce herself in a moment, but if you could please write down any questions that you have in the question box on your webinar column there. We will hold questions until the end just so that we don't disrupt the flow of our presentation, but please do go ahead and write them in as you think of them. And finally, these slides will be available on our website afterwards so that you can review them at your leisure if you'd like to come back and look at them again. So with that, I'm going to let our speaker introduce herself and start the presentation. Thanks.
All right, thanks, Janice. Good afternoon. My name is Shawnielle Predeoux, and I'm an attorney and a CPA, and I started my own practice last year. In my practice, I prepare tax returns. I work with clients in resolving tax issues. I also do estate planning and some business law work. And one thing that we all run across in assisting taxpayers with their tax issues is that they often don't have adequate records, and records may have to be reconstructed either as support for their return or to help them with their IRS issues and to provide documentation to show support for their expenses. So today we're going to talk about the adequate records that are generally required, the IRS position on record reconstruction, and then talk about some ways to reconstruct records. In general, all taxpayers are required to keep records. They can keep records in any manner they choose, but documents that are sufficient to show their income include, cash register tapes, bank deposit slips, receipt books, invoices, credit card charge slips, and their 1099 miscellaneous forms. And with expenses and also purchases and things for inventory, they should maintain canceled checks, their cash register receipts, credit card sales slips, invoices. And also for items that require additional substantiation, like their travel expenses, they have to maintain documents that show the amount, the time and place or date for gifts and business purpose of the expenditure. And many times, taxpayers may have some records, but they don't have adequate records. And that's why the IRS will deny their expenses. And what a lot of people do, the IRS will ask for their bank statements and things, and they'll submit those, and then they'll still deny the deductions because they don't adequately address, for example, the substantiation requirement in 274D, or they may not show the dates. So with respect to the IRS position or authority for record reconstruction and publication 483, with respect to travel expenses, they talk about destroyed records, and they state, if you can't produce a receipt because of reasons beyond the person's control, you can prove the deduction by reconstructing records or expenses. Also, there's a lot of information on record reconstruction with respect to earned income tax credit materials for tax professionals. And in the facts there, they know, what should you do if your client doesn't have receipts or records to show their income and expenses. Would you be required to refuse to prepare the return in the case of an original return or for non-filers? And their response is no, you should, not necessarily, don't have to refuse. You can take the opportunity to teach your clients about record keeping requirements and help them reconstruct records or make a reasonable estimate of the income earned and expenses. In section 274D, it requires taxpayers to provide additional information for expenditures with respect to travel, gifts, and their listed property. And it recommends that they provide, maintain logs that are prepared at the time they incur the expenditures, but it's not necessarily required. So if they don't maintain documents at the time, they incur those expenses, 274D does allow them to substantiate the expense by sufficient evidence corroborating their statements. And regulations further state, if the record is not made at or near the time of the expenditure, then they have to have reliable documentary evidence to corroborate it. And reliable documentary evidence includes documents that are created by third parties such as banks and credit card companies. So the banks and credit card statements are a source, but they're not all the information you need. Okay, so basically, when you go through the process, if you have a taxpayer that comes in either because they received an assessment because they didn't file a return because they didn't have records, or they filed a return and their expenses were denied and they don't have records to support them, or they want a return prepared and they don't have records, what do you do? So your first step is to interview the taxpayer. And this is very important because in this process, the responses that they give you will determine, how you proceed. And because every taxpayer's business is different and how they maintain their information may be different, you have to look at the responses to determine what you're going to do. So first in the interview, you have to determine how they receive income. Do they receive most of their payments through credit cards that are deposited into their bank accounts? Do they receive a lot of cash receipts that they either deposit or have cash register sales slips to show what's received? You also determine the types of expenses they have, and they'll tell you that. And then identify documentary evidence that can support those expenses. So for example, you have a lot of drivers, and with drivers, vehicle mileage logs are something that the state and the IRS will audit them for, especially Maryland. They've been, very aggressive in auditing even taxpayers with minimal income that are drivers to make sure they have logs. And if they don't have a log, they'll automatically just deny their mileage deductions. So in some cases, if they are in the sharing economy and may do DoorDash or something like that, DoorDash will generally be able to provide them with a report that shows the trips that they made, and they may be able to go back and obtain that information. If they're a driver, for example, that drives a specific route each day, there may also be additional evidence that can support their mileage. So for example, their employer or their client that hired them, if they were an independent contractor, may require them to check in either on the phone or through an app if they have to go to those different places just to verify that they're there. And they can then obtain documents from those people just to support their mileage. What some people do, if they have a specific route that they do every day, they will just multiply, like if they say their weekly mileage is 550 miles, they'll multiply 52 by 550 and take the miles for that. That will be disallowed. They have to come up with reasonable mileage based on their actual route. So if they can show like which days they drove and where they went, you can come up with mileage that way. You should also obtain an income and expense statement, because generally, you know, if they have high expenses that they're paying and the income that they're reporting doesn't show that, or, you know, they don't say that they received any non-taxable income such as insurance proceeds and whatnot, you may have to provide an estimate to satisfy the IRS as far as their income, and we'll talk about that a little bit later. And you can obtain the income and expense information. You can use the collection information statement because it's very thorough in what it asks for with respect to their income, expenses, and assets. And after going through this process, you know, and hearing how they earn their income, how it could possibly be recorded, and in the interview, you'll learn what third-party sources would possibly have documentary evidence. Then you would request that they obtain copies of that available evidence if they don't have it currently. The Earned Income Credit Toolbox provides record reconstruction training on the IRS website, and the link is here. So basically they tell you, you know, some ways you can reconstruct records. For example, with respect to mileage, you can use online map tools such as Google to reconstruct the mileage calculations. And when you do that, you can reconstruct the log. They have to show the business purpose, where they traveled. And then you can use Google to map the route. You can also use appointment books or calendars. And those can be used to develop, you know, who they go see, account of how many people services were provided to, and different things. Checkbook, canceled checks, bank statements, and credit card statements are an excellent way to obtain documentary evidence. So for example, with travel expenses, credit card statements will generally contain if they have hotel charges and food charges, the credit card statement will have the city and state where the charge was incurred. So that would, if they said that they were in a certain city on specific dates for either a conference or to meet with a client or whatnot, then the statements would support that and also support the expenses, because it would show the amount, where they were incurred, and supports their oral statements of why they were, or of their business travel. They can also obtain corroborating evidence of their business travel if they met with someone, have them testify in order to provide all the information required for 274D. Right, and then also, for example, depending on the purpose of the travel, for a conference, they may have the conference registration receipt in addition to a brochure that shows the dates and times to support the location, date and time they were out there, and that would be corroborated by the credit card statements with respect to lodging, meals, and things. All right, so in most cases, taxpayers will have some records, and you can use those records to reconstruct their expenses with respect to travel and expenses that have to be substantiated. Those are some of the deductions that are disallowed most often because the taxpayers can't do that. So you can use the bank statements and things like I mentioned earlier to substantiate, well, to show that they actually had those, incurred those expenses, show the city and state. No, it won't show what was actually purchased, but if the amounts are reasonable, that will generally suffice. With respect to hotel charges, in most days, in most cases, people will make their reservations online and receive a reservation confirmation. And I know for my email, I have emails back. I keep all my travel emails back for like 10 years. So if they don't delete those, you can request that they go into their box and at least on a sample basis, provide some of those confirmations to show where they traveled for the airline charges and also for the hotel charges. The confirmation will show how many people were scheduled to be in the room and also verify the date that they were set to travel to also further support the expense on the credit card statement. In the absence of those, and if it's not something that has to be substantiated under 274D, the IRS, you can provide an estimate as permitted by Cohen. And the IRS has specific methods that they use for estimating income when there are no records. And some of these can also be used to estimate expenses. And of course, you know, if they can use them and these methods have been blessed by the court, it's something that you could also use in order to reconstruct income and expenses. So one method that they use is a source and application of funds method. And it basically analyzes cash flows to determine income by the amount expenses exceed income. And for this method, it is generally used when, you know, the taxpayers don't have all of their funds deposited into a bank account and they have a high cash flow business and operate in cash and also pay their expenses in cash. So you would use this method in order to come up with the income to show that that was reasonable. You also have the bank deposits and cash expenditures method. It's very similar to the source and application of funds, except you use the bank statements to come up with the income and expenses to determine what the actual income is. And then another method is the net worth method. And with the net worth method, you have to evaluate financial information, including their assets, in order to determine, you know, the increase in net worth during the year. That is evidenced by bank account balances, also additional items that they've purchased. And in doing that, you'd also look at loans and things that would not be taxable income or deductible to come up with the net worth amount. And all of these methods are contained in the Internal Revenue Manual in section 4, chapter 1, part 4, chapter 10, section 4. Now for businesses that maintain inventories, you can use the unit and volume method. And that method applies the sales price to the volume business. So that could be used for a business that has an inventory, or if the business has like similar clientele. Say for example, a masseuse sees, you know, they charge $60 for each hour massage. Oh no, that's cheap these days. $100 for each hour massage, $150 for each 90-minute massage. So they may have their appointment book to show how many clients that they saw that day and the service that was provided, and then you basically use that to determine their income by multiplying the sales price for the service under the unit and volume method to obtain their income for a period. And then you also have the markup method, and this is used in inventory intensive businesses. And with the markup method, you obtain industry averages and determine what the markup is. And if the business's markup is really low or the expenses seem really high, they'll the IRS will generally adjust it. Locations for obtaining these industry averages includes the Bureau of Labor Statistics averages, and they contain statistics on expenses. And then there's also BizStats, which contains averages based on the industry type. And it shows averages, for example, gross profit and expenses and things. And those averages can also be used to estimate expenses for a business that, for the types of expenses that are not required to be substantiated. And we're done. And basically, when you reconstruct records, you have to be very thorough and ensure that you create records for the entire year if you're required to by 274D. So some examples, if you are preparing your mileage logs after the fact using some other documentation that showed where they were traveling to, and then you also do the Google Maps, you would have to make sure that the record is detailed and contain everything, contain the business purpose, say for example, met with client in location, then have the miles. I also include where they traveled from, where they traveled to, round trip. And in those cases, the tax court will accept them and the IRS's will accept it also because it's a reasonable estimate. Then, if you have mileage deductions that aren't corroborated or were estimated where they just rounded up, then they'll generally be denied. So as I said before, in the EITC reconstruction, Google Maps is a good tool to use, or another online map application to calculate the mileage. And what I also do when I do that is I'll include an entry that says mileage support. So if they travel 200 miles, say if they travel to New Jersey or New York, with the mileage support, I'll include credit card statements that show that they actually stopped at gas stations, and I'll include the gas charge, the mileage support, and also include any toll charges. If they have their Easy Pass records, that's great. You'd have the actual support. If not, and you create the route that they took, which is based on, the route that they generally take, and there are tolls along that route, there is a toll calculator online that you can use to estimate tolls. And if you go back years, you will have to go back and adjust the tolls for changes that were made. And for example, in Maryland, that's shown on the Department of Transportation's website. You can find that information to go back. And you can also do a Google search and find that through news articles. But, also, so you have to be thorough and recreate records for the entire year that contains all the elements that are required to be reconstructed, because if you don't, they'll also disallow it. So for example, when the IRS requests their bank statements and credit card statements from business owners to support expenses in an audit, and that's all they provide, and they have a lot of travel expenses, it's disallowed because that's not sufficient evidence to substantiate under 274D. The credit card statements don't show, the business purpose of the travel or who they met with in some cases. And in some instances, it also may not show the location or what was purchased for the food and whatnot. So you should try to obtain corroborating evidence, such as confirmations to show who was in the room for lodging purposes and things like that, or where they traveled to for airline purchases. And then I had one final tip. And also, if you do use estimates in order to prepare, information that you submit to the IRS, when you prepare a return, you should report how you created any estimates or positions that you took on Form 8275. And any person, any tax preparer that does that will not be subject to penalties if the IRS doesn't agree with the estimates used. And there are some cases out there, if you check, in some cases, so the IRS actually recommends, that you use BizStats, but you can use any reasonable industry information that supports the business. And it's also good to be very detailed. So for example, there was one case where the IRS used BizStats to come up with the income and expense figures for a trucking business. And the trucking business was a local mover that moved household goods, and the IRS rejected that. I mean, they came up and they just used the BizStats estimates for general trucking businesses. The taxpayer countered and provided a more detailed estimate from BizMiner, and in that report, it was for moving household goods, trucking businesses moving household goods, and the amounts were actually less, and the tax court accepted that because it was a more reasonable estimate of their actual business. So when you do that, you have to make sure that the estimates correspond to the business types. If you go online, you'll see that BizStats is a free service that's provided. BizMiner, you have to pay for those reports, and you can get those for different periods, but in some cases, it may be well worth it. But generally, in reconstructing records, there's no one way to do it, and you have to actually obtain information to determine, what records are available to you to determine how you're actually going to reconstruct those records, or if they can be reconstructed. For example, with some people, they may use, if they have merchant card expenses, and you review their contract and you see that their merchant card expenses are a certain percentage of the transaction, you can recalculate, the income from those charges using that. But there are a lot of different ways and things that you can do to actually reconstruct records. But the takeaways from this is, when you do reconstruct records, make sure that there's some way to substantiate, the taxpayer's testimony, whether it be through bank and credit card statements. And with respect to 274D expenses that have a higher level of substantiation, that you provide all the information required when you reconstruct the records, so that those expenses will be accepted. And that's pretty much it. Do you have any questions?
Great, thank you. So yes, there is a question here that says, do you disclose that reconstructed records were used on the tax return on the Form 1040?
Well, you attach Form 8275 to the 1040 and disclose that you used, yes, reconstruction methods and estimates.
Okay, and then with the reconstruction methods that you used, would you have to clarify which one you used? Because I think on the one slide you had a couple of different methods.
Right. So if you use, one of the IRS methods, you should disclose which one you used. And if you use some other method, the thing is, if you disclose, then the IRS can't take or can't assess a penalty against the preparer, and they can also understand how the information was contrived. So they do encourage disclosure, and you just have to state how you did it, no matter what method you use, whether it was IRS method or another method that you came up with. If you use a industry report in order to come up with the percentages that you use for that taxpayer, disclose that information, but be open in how you did it, because if they can go back and on a test basis substantiate what you did, it's going to be permitted.
Okay. Okay. So the important thing is that you do have to include that form 8275. And that also, it sounds like it confers some protection for the tax return preparer then.
It does.
That's great. So that's always important to include that. And then as far as the different methods, on the slide that you had listed several different methods, is there some detail on those methods on the IRS website, or
Yes,
how would
if
we
you go
find out more
to
about what
the
those methods
Internal Revenue
entail?
Manual, I'm sorry, Janice. Yeah, if you go to the Internal Revenue Manual, Part 4, Chapter 10, Section 4, it is the chapter on, the IRS auditing income, and it provides examination of income, and it provides for these methods. In that chapter, it provides examples on actually using them. It provides court cases in which the methods were upheld and different things with respect to each method, like when it would be best to use it.
Okay, so really, it seems like there's no one right way of doing things. It's really more a matter of being creative and innovative with the options you can use.
Yes, that's very true. And like I said, it just has to be something that is reasonable and can be supported. And the more, if you are using, you can only use estimates if there is no documentation for you to use to reconstruct expenses. And when you do use those estimates, it has to be, related to the actual business that you're preparing them for. And it should be within the same industry. And the more specific you can get, the better. But if you use the general biz stats, that's acceptable. But in some cases, it would benefit the taxpayer to pay for the report and get, a more specific report from BizMiner or another site. Once the burden of proof shifts to them, if they can provide documentation that shows their method was reasonable, the courts will generally accept it.
Okay. Great. Very good. So a reminder, if anybody has any questions, to please go ahead and type them into the question box, and we'll review them. But I think this has been it's been a very eye-opening in seeing that there's really several different ways that you can come up with information, and it's I think many times we get stuck with sort of the way we do things, and it's nice to be able to see that the IRS is willing to accept alternative methods. Have you yourself had much experience where, I guess my question would be sort of, what is the pushback that the IRS has? How do they respond to these sort of different methods? Do they seem to be pretty open to accepting things as long as they can be substantiated?
Yes, they do. I mean, they really do. If you can substantiate them, and especially, like I said, with respect to the expenses, if you do have corroborating, supplementary documentation from third parties, whether it be testimony from someone who was there or bank records, they will accept that.
Okay. And then does it matter sort of where they're asking, for example, during an audit versus an audit reconsideration later on, or even in court? I mean, does each level sort of have, do they all accept the same things, or some perhaps more accepting than others? Have you found there to be much difference, or?
Well, the important thing is try to work with them. I've seen them accept an audit reconsideration, and in court, where the court is generally going to disallow expenses. If they reconstruct records after the case has, the trial date, the court won't accept that, because they say that they don't allow the other IRS, the opportunity to question that method to ensure that it's reasonable. But in any other situation, if you reconstruct the records and provide them at that time, it will be permitted. And the corroborating evidence is required just to show, that the taxpayer is telling the truth. And that's shown, by their testimony, if they can be specific and whatnot in their testimony. And then they also have, bank statements and documentation that support the information that they provided. Is going to be accepted. Whereas, if they're uncertain in their testimony and they don't really have much corroborating evidence, it's going to be rejected.
Okay. Wow. Very interesting. Well, I think we've learned a lot here. I mean, it's really interesting to see the different ways that are available, and it's important, it sounds like, to really just sort of be creative and open to different ways of providing the information or presenting it so that you can best advocate for your client. So
Right.
Great.
And then the interview is key, because in that you can kind of identify some additional third-party documents that can be obtained to corroborate what they say. And also in the interview or when you obtain information on their income and expenses, that may be used later if you have to come up with some estimate. So the initial legwork is very important.
That first interview when you're meeting with your client, and because sometimes we may not understand exactly what the client does or their expenses and things, but then having a deeper conversation with the client may provide you with more information regarding that.
Right. And you may have to ask questions just to ask about their business to understand that in order to get the information that you need. If you ask general questions in the beginning, how do you earn income, how do you earn expenses, whatnot. I mean, what expenses do you have? They may not provide all the information you need. So you do have to provide, ask more detailed questions, or just ask them to describe what they do, during the day to see how they would earn income or what expenses they would incur. Right. And I was an auditor, attorney, and this process, was used in identifying internal controls and things, and in performance audits and identifying what to audit. But yes, the interview process is key because you can obtain a lot of information to determine how you're going to proceed.
And I think also, like you said, it's also a good opportunity to educate your client for the future so that hopefully you're not doing this again next year. And because they're keeping, and even if you do it again in the future, hopefully they will have better records at that point.
Exactly. And so when you do go through this process and you provide the taxpayer, with the information that they need to maintain, and, they'll review what you provided to the IRS and what was acceptable, then yes, they know what records they have to maintain and retain in order to support their expenses and things. And it will make it easier for them in the future going forward.
If this happens again, sure. And then I think you had mentioned that a suggestion in terms of how long to keep these records going forward. Is there a time frame that you recommend to your clients that they should keep their records?
Right. So it generally depends on the types of records. So at least 6 years. And if it's stuff or assets and whatnot, you should keep them for a few years after the asset is disposed of. So you can retain those for a long time. So it really varies. But
and so in terms
for a regular return, if they file the return and it wasn't audited, and the statute of limitations has expired and the information provided on the return was reasonable, they don't have to keep, they only have to keep them for a year or so after that statute has expired.
And then in terms of saving space these days, is it possible to scan all these records and then, or do you recommend keeping the hard copies, the original hard copies?
I would keep, I know for my own business, I scan the records and also keep hard copies, but I keep the scanned records on different, drives just in case something happens, just so you would have them available if something would happen.
Okay, so you have like a backup copies then.
Exactly.
Okay, but you do, when you scan your records, then do you still keep the originals for a while as well, or?
I do keep the originals for a while, but if you don't have to have the paper documents, you can use the online documents and reprint them. But if you don't have
Okay.
enough space, you know, you can destroy the paper records if you have backed up the online ones and are confident
Okay.
that you'll be able to access them, you know.
Right. That's always a question. So, okay. Well, great. Well, Shawnielle, thank you so much. I think this was very interesting, and I think it was very helpful to encourage people to think outside the box and to look at different ways that we can recreate some records. It's not uncommon, unfortunately, for clients to come in without anything or to come in with just very little, because they just don't understand what the IRS is looking for. And so I think it's part of our job as being a good client advocate is to be able to look at their situation and see how best we can help them. And sometimes that requires thinking outside of the box and looking at different methods. So thank you again for this very interesting presentation. So I think that's it for questions right now. So again, we will be able to post these slides on our website later on, and I do encourage all of our volunteers. This is available for all of our volunteers to access. So, and if you are not yet a volunteer, I do encourage you to sign up to be a volunteer so that you can have access to all these great trainings, so, and the materials that they provide. So thank you everyone for joining us today, and thank you again, Shawnielle, for speaking today.
Thanks, Janice.
Thanks. Okay, take care everyone. Bye-bye.